Gold was the surprise star of 2025, rising approximately 60% to breach $4,000 per ounce for the first time in history. If you had told most financial advisors at the start of 2025 that gold would outperform the Nasdaq, most would have rejected the idea. It happened. Four drivers combined to create this extraordinary move. First, trade uncertainty and geopolitical stress drove safe haven demand. During the April equity sell-off, gold rose while stocks fell, exactly the diversification behavior investors want from a hedge. Second, 3 Federal Reserve rate cuts reduced real yields. The opportunity cost of holding a non-yielding asset like gold fell, making it relatively more attractive. Third, central banks bought over 1,000 tons of gold for the third consecutive year. China, India, Poland, Turkey, and other central banks continued their strategic shift away from US dollar reserves toward gold. Fourth, gold ETPs attracted $43 billion in inflows in 2025 to 27 times their 2024 level, as retail investors embraced gold through low-cost ETF wrappers. Not all gold investments are created equal. Let me walk you through the options from best to worst. For most U.S. investors, gold ETFs are the optimal vehicle. IAU and GLDM from iShares and the iShares GLDM fund offer expense ratios as low as 0.10%, full daily liquidity on the stock exchange, and precise tracking of the gold spot price. This is where most retail investors should start. Gold mining stocks, Newmont, Agnico Eagle, Barrick Gold, offer leveraged exposure. When gold rises 10%, miners can rise 20% to 30%. But they add management risk, operational risk, and can dramatically underperform spot gold if mine costs rise, or if management makes poor capital allocation decisions. Gold streaming companies like Royal Gold and Wheaton Precious Metals offer a more stable form of leverage. They receive royalties on mine production rather than operating mines themselves. Physical gold, coins and bars, is the worst vehicle for most investors. Buy-sell spreads of 5% to 8%, storage costs, insurance costs, and zero yield all-erode returns. On allocation, most professionals suggest 5% to 15% of a portfolio in gold. The 2025 experience, where gold served as a genuine hedge during the equity correction, validates that allocation. This is the disclaimer slide. All content in this presentation is for educational purposes only. It does not constitute investment advice. Viewers should consult a licensed financial advisor before making any investment decisions.